Hey guys, welcome to the Wealthlab podcast. And today we wanted to do a little bit of looking behind what the curtain looks like and how we find new clients. We've done a lot of information around the products we talk about, e.g. superannuation, investment planning, super strategies. But a common question that we thought we'd put out there, which is how you, the listener, have found us. So Phil, what's the traditional way of finding financial planning clients?
Oh, I don't know. Either your accountant or your mortgage broker or your mate at the barbecue might have suggested someone, or you've just hit the old Google and found someone local or something like that. It would be probably fairly common.
Love a good mate at the barbecue.
Yeah,
always the best ones. Traditionally, that was how we found our clients. If you followed our trajectory over the last 10 years, you've probably come across me through a mortgage broker, through an accountant, through us bumping into the street somewhere. I know through Phil's workplace, you've had people find you in the gym. You've had people track you down from a bunch of areas.
Yeah. LinkedIn, gym, all sorts of places. Accountants.
Yeah. What we are also doing is we're also doing some online marketing. We're doing some online advertising. So you might have seen some of our Facebook ads. You might have seen our YouTube reels, or you might have seen this podcast. We put this out free so that when people are looking to make a decision around choosing to work with Wealthlab, they've got a concept of what we look like, what we sound like, how we talk. We're not right for everyone. We're certainly right for a lot of people, though.
Yeah, I think so. Definitely not delivering your old school, stuffed shirt in a fancy office in the city somewhere, that's for sure.
It's not our style. And I think one of the nuances of the Wealthlab business is that we really work with people online across the country. And that's probably a key value add that we can do, because we can offer our services at a really cost competitive rate compared to our peers. Yeah. With the one exception, if I can walk to your house from my front door or from my city office, I'll come and see you.
Yep.
But the rest is going to be online.
Yeah, I think that's fair. I mean, that covers pretty much my entire postcode. I could just about walk to, but...
So look, if you have seen our ads, that's great. Hopefully they resonated. Hopefully you liked them. We do put a fair bit of effort into it. And we usually will link people from either Facebook or Instagram or YouTube or just the website. We're also running a quiz as well, which is and what that quiz does is, and that you're here because you've obviously been screened through it. If you're a bad fit, that quiz will basically just say, here's the Money Smart website. We really probably can't help you. If you get through that quiz and they say, yes, you're a great fit for advice, that's how we operate. That's how we find new people. If you think we could have value for you, please put forward this podcast to a friend or a family. We're always willing to help people who are in need of great advice. So guys, if you've seen one of our ads, if you've clicked on any of our YouTube videos, or you've had a conversation with someone and they've passed your details on to us, we do genuinely offer a complimentary first conversation with us. And that's going to be an assessment of where you're at today, what your goals might look like, and if you're a good fit for financial advice. Not everyone is a good fit, so you really need to have a think about if you are. We want to work with people that have at least the mindset for taking on good advice. You don't want to walk into a doctor's office and tell them that you know how everything works. I don't know why, but some people come and have a meeting with us and then try and tell us how things work. Fine, do that. Don't work with us. That's okay. You can have a crack. You can have a punt.
Yep.
I would prefer to take the expert advice generally, and I think if you're talking with Phil or myself, and we have a recommendation for you, it's probably going to be in your best interest. Actually, by law, it will.
Has to be. Yep. 100%. And come prepared to talk about your broader situation. Everyone comes in wanting to review their super fund or ask some tax questions or whatever. But the reality is that there's probably a whole bunch of stuff you don't know that you could be doing. And we're here to talk to you about all that. So come prepared to talk about your retirement, your plans, your goals, hopes, dreams, all that fluffy stuff that's maybe not just hard numbers, because that's really where the magic happens. All these things around superannuation and tax rates and whatever, they're just vehicles to get you where you want to be. So let's be prepared for that conversation as well.
Yeah. So look, I'll give you. So I'll say there's the three sort of common mistakes that people, if they're clicking ads, if they're seeing stuff on the internet, is be mindful about chasing things that look hot. If it's shiny, if it's got a really great content around it, probably not. Just be careful.
Yeah.
The rise and fall of, say, crypto in 2017 and then 2021 and then 2024. There's just this rash of grifters that come in and come out. So if it seems really exciting, don't do it. Not with your money. Definitely not. I think another one would be ignoring your super for years until retirement is looming. People still have got multiple super funds, which is sort of plobbing around or they've lost it. Great opportunity for us to be able to do a super search and combine them.
Yep.
And Phil, what would you say the third one around pressure pitches? Talking to salespeople.
Mate, if anyone's sitting there trying to force you to sign on the dotted line right in front of them in that moment, if you're not feeling ready, that's got to ring some alarm bells as well. Like if they're giving good advice, they should be prepared to stand by that advice and for you to fully understand it before you move forward. So, and actually I use the word advice, but quite often a lot of these ads that you're clicking on that you're getting high pressure sales tactics, they're not advisors. They're just trying to flog something and they're unlicensed. So, make sure you look up who you're dealing with, deal with a licensed advisor. And, take the time you need to consider what they're recommending and work with them.
And what Phil's saying is that we will meet with you, do a statement of advice, and you can read it. Take time. Don't we'll send it to you. You can read it overnight. You can take a week, whatever works in your own terms. I myself put my details into one of the compare your super things a couple of years ago, maybe about a year and a half ago. And this guy calls me, and I think he's been speaking to me for 30 seconds, maybe less, maybe 40 seconds. And he's already trying to tell me about how a SOA is a 30-page document that you need to sign. It had been in under a minute that I'd been on a call with someone who was obviously trying to sell me some weird financial planning service that I put my details in when I was myself scrolling Instagram. And I just remember this is such a weird, why are you framing this up front so fast? And I think it's obviously we can see with what's happening in the news at the moment, it was all about the speed of delivery and not giving people that time to consider what was going on.
We use your doctor analogy again. It's almost like walking into the doctor's surgery and he says, "G'day," and hands you a prescription before asking any questions.
Is that a bad analogy? Because don't doctors isn't there something weird about how doctors get, the medical sales reps to push and give them financial benefits?
Probably,
I don't know.
I don't know.
I know. I guess all industries suffer from that question, don't they? So look, guys, the promise that we can give you, if you send us a friend of yours, if you've been through our process, you know what it's like. You're not going to be pressured. You're going to have a couple of goofy guys talking to you. We're going to do our best. We're going to implement and action it well, and we're going to be here in the long term as well.
Yeah, and just on that, actually, I have had a lot of clients send me referrals, particularly recently for whatever reason. And I'm sure if you're listening, you know who you are, and thank you very much. It is deeply appreciated, and we will look after it.
And on that, Phil, what the hell's going on with interest rates?
Oh, well, it's interesting. I don't know. It'd be interesting to see what pans out and whether we see a few more cuts to come or not. I don't know if I necessarily have a view. I was actually maybe slightly surprised to see that cut. I thought they might have held the line. But yeah, I guess we'll see. I mean, we've just come off the back of a bout of just absolutely rampant inflation, just starting to get it under control, and now we're cutting rates again already. It's an interesting tact. I know there's probably a lot of political pressure for things to happen, but of course the RBA should be independent and political pressure shouldn't come into it. But I don't know. It's a bit of a false economy maybe, because we're at a point where, supposedly we're cutting interest rates to stimulate the economy so people have got a few more dollars in their pocket. But at the end of the day, our dollar's weak and weakening, just going to make stuff more expensive. So I don't know if it's really going to help.
Yeah, I completely agree. And I think we're talking to our clients here. So if you're talking to us about your investments, higher interest rates actually benefit you because it has a stronger Aussie currency. So the Aussie dollar buys more. The income that you get paid on your fixed income and your cash is higher. And the rate of return that you need to be paid on your equity, your shares, your international shares, your Aussie shares needs to be higher again. So if you're an investor, higher interest rates benefit you because that you need to be paid what's called a risk premium above the base interest rate.
That's right.
And to be rewarded. Yep. Lower interest rates reduce that risk premium, punishing those people who are putting money into a bank account, forcing them to basically gamble on the market because there's such little rates, which means you need to go up the risk curve, taking on more risk for a similar rate of return that we'd be able to get if the interest rates were 4 or 5%.
Yeah, and it's also a little bit concerning. I mean, we look at market valuations at the moment, like CBA being a prime example, all over the news, just absolutely insane share price. So much money flowing in because of, the way a lot of funds and stuff are approaching their investment using a lot of indexing methods and stuff.
Do you want to drill into that, Phil? What do you mean by that? Be more specific.
Yeah, we've got a lot of I mean, when you think about indexing, investing via an index, everyone's probably heard the term. No one really necessarily understands what it means, or a lot of people don't. I just find a simple way to explain it is, if you're watching the news at night and they're talking about the ASX 200 or the S&P 500 or whatever else you're seeing. Those things are indexes. So the ASX 200, for example, top 200 companies on the Australian Stock Exchange. So when people take an indexing approach to investment, and a lot of the big funds are kind of hugging the index because they don't want to be seen to be straying too far from the market in either direction, that means that they're kind of just replicating these indexes. So if something like a company, for example, like CBA is being bought a lot and it's driving the price up, that means that, if you're in an index, if you're taking an index method to your investing, then you need to buy more of that as well to keep up with the index. So it forces more money into these shares that are already probably overpriced anyway. Lower interest rates is probably going to drive more money into the market because people will be hunting additional returns because they can't get it from cash. And it's potentially just going to continue to compound that problem. Maybe I'm wrong, but we'll see.
Yeah, I think just on that, the Australian market now is effectively just the Commonwealth Bank. It's it's the largest and most expensive bank on the planet.
Yeah.
So if we think of every single other bank in the world, the CBA has the highest share price in relation to its assets. What that actually means is that I've got the National Australia Bank share price up in front of me. So if you buy one share of the NAB today, it's going to pay you a dividend yield of 4.3%. Pretty good, not a bad dividend. That's a fully franked dividend as well. So you get a bit of equity premium on that, but there's 4.3% dividend yield. If you go and buy a CBA share today, right now, you're only going to get a 2.8% dividend. So it's like almost half.
Yeah.
It's like that's like a 60% difference in dividend from the NAB to the CBA. Not a huge different industry they're in.
No. What's the bloody difference? They're just another big bank, aren't they?
Yeah. And that's probably more of a reflection in terms of the positioning that we're taking from our investment perspective, trying to reduce our equity portfolio risk within our wider world. But these guys are benefiting from the changes in interest rates. They'll put their margin on it no matter what happens. And I think that the key thing that you need to be listening, if you're listening to this podcast, is are you an investor or are you a borrower? If you're a borrower, obviously ensure that you're on the most competitive rate. The banks will punish you for being a good client.
Yep. Yeah, 100%.
Don't need to stick to the majors as well. There's 400 banks in the country, including all the credit unions.
Yeah, non-bank lenders, the whole shebang.
Yeah.
And the other thing I'm just going to throw out there, if you are a borrower or you're considering borrowing and you are listening to this, don't be sucking into the 600 emails that I received the other day saying, hey, your borrowing capacity might have increased now because the rates have been cut. Look, I've seen a lot of people that got suckered into borrowing a hell of a lot more than they could afford through COVID while rates were at 2%. Now they're at 6%, they're struggling. Don't fall into that trap.
Phil, can you just explain that, please?
Yeah, 100%. So
how does my borrowing capacity change if my income's the same, my savings is the same, but the interest rate drops?
Yeah, so the interest rate reduces, which means that your minimum repayments required to service the loan are lower because you need to contribute less. Like less of each payment is going towards interest, more towards principal, which means over a 30-year loan term, you can borrow more money because theoretically, under current rates, every payment you make is paying a bit more off the principal. But as we saw through COVID, rates fell really low. People hocked themselves up to the eyeballs and then rates returned to normal. 6% is normal. We've all forgotten it because we've been so low for so long, but 6% is normal. If I'm here and I'm buying a house tomorrow, I would probably be budgeting my repayments on, say, a 7% interest rate.
Really? I'm pretty conservative.
Maybe I'm pretty conservative, yeah, but I don't want to be in a position where I've borrowed money at, 4%, low 5s, something like that, and then rates increase, which they will, and now I'm scrambling to make repayments because I've borrowed more than I could actually afford because, the bank told me it was okay because they're trying to lend me more money than I can really afford to repay.
Oh, Phil, you don't sound like a politician at all. You're supposed to tell me how cost of living is easing and how the interest rate drop is going to make my life better.
Mate, I don't know if you've been shopping recently, but the cost of living sure as hell is not easy.
I think, yeah. So So the summary is that rising interest rates, falling interest rates, you're a net. It's effectively net out because if you have an investment portfolio, rising interest rates tend to benefit you. But if you're borrowing money, they tend to hurt you because you've got to pay more money for that. Yeah. As sort of, I guess, the spectrum of the world ages, sort of the older people tend to benefit, bless you boomers, from higher interest rates. And the millennials and Gen Zs tend to get hurt by them just trying to get into the property market and dealing with gigantic mortgages.
Yeah, I saw something the other day, and it's the difference between, it's like you used to be able to buy a house for two times income, and now it's like 5. Insane. Yeah. Absolutely incredible.
And that's the financialization of the asset class, as well as the tax benefits you get from property have actually pushed it up.
Yeah,
So, guys, I think we'll end it there. Look, interest rates are they're a bit of a minefield. You can get weird when you go overseas. You see where like interest rates are completely different in other countries. What the hell's going on here? It's certainly something to be mindful of. I think the banks generally don't reward you for being a good customer, so be on the ball with that.
Phil, loyalty tax.
Have you got any other hot takes you want to have on in relation to the the interest rate environment?
Not really. I just want to continually hammer that point. Don't borrow more than you can afford at a higher interest rate. That's it. I'm leaving it at that.
But Phil, what happens if I want to buy a $100,000 car at a 9% interest rate?
Appreciating asset at a 9% interest rate. You know my thoughts on motor vehicles. I'm driving a nearly 20-year-old heap of crap because I can't stand spending money on them.
Maybe we should say, if you do it, tell your spouse, because that's awkward when it comes down to fact line.
Yeah, definitely do that.
All right. Yeah. Thanks, guys. Thank you so much for listening. We'll see you next time.
Beautiful. Cheers, guys.